In 1990, Josh Friedman founded the Los Angeles-based hedge fund and alternative investment firm Canyon Partners with his law school friend and former Drexel Burnham Lambert colleague Mitch Julis. Canyon launched its first hedge fund, the Canyon Value Realization Fund, in 1993. Today, the firm has more than $24 billion in assets in a variety of value-orientated strategies. Friedman expects turbulence ahead and anticipates hedge funds to be best equipped to thrive in volatile markets.
One of the things that I'm sure of from being in business for 30 years is that there will be change, there will be disruption. Markets are always becoming turbulent exactly when you least expect it. We're in a moment of incredible calm and low volatility right now, and I think a lot of hedge funds will be very well positioned to deal with that kind of turbulence. And people in traditional asset classes who have enjoyed very good returns might be least prepared for that type of turbulence. The hedge fund structure is very different fundamentally and offers some pretty enormous advantages compared to long-only structures. Typically, hedge funds are not benchmarked against particular indices. They're not forced to buy when they have inflows. They're not forced to sell necessarily when they have outflows. They can hold cash. Some can hedge. Some can be leveraged. Others are not. But the flexibility of the mandate, together with the less liquid structure of their investors, i.e. they don't have to deal with T+1 daily liquidity, lets them engage in a lot of strategies that long-only managers can't engage in. And a lot of the pricing is going to be determined by flows as opposed to by fundamentals in the long-only business, as it has in the past. I think that trend might particularly be the case in the future, given that the investment banks and the commercial banks are using a lot less capital to make markets. So it means that flow-driven downturns in prices can be a lot more dramatic and leave those with more locked up capital in a better position to take advantage of those pricing volatility movements. I think the relationship between asset managers and hedge funds is evolving in a variety of different directions at once. A number of hedge fund managers have gotten to the point where they really don't have to be terribly flexible in terms of the way they move for different investors because they don't have infinite capacity for what they do. These include some of the finest managers who have extraordinarily specialized skill sets and long track records, and they're not going to be willing necessarily to turn themselves into traditional asset management firms. On the other hand, traditional asset management firms we do see trying to produce hedge fund type products, but I think there's a fundamental clash in the culture between some of the long-only traditional asset management firms and what goes on in a more entrepreneurial environment of a hedge fund that make it difficult for them to make that transition. I think that some managers will experience fee pressure. We're seeing that today. We're seeing larger institutions attempt to extract different terms in exchange for locking up capital. And different fund managers, I think, will react quite differently to that. Some will seek any capital they can and be willing to compromise on their fee structure if they can lock things up. Others will not. As far as Canyon's concerned, we haven't made decisions to go full bore into other asset categories or other product lines the way some firms have. We've done a certain amount of experimentation with other types of formats and asset classes. For example, CLOs is something we've done for a very long time, and it helps us get a more complete view of the entire bank debt market. A number of people are experimenting with 40 Act type products, etc. But I think you have to be extremely careful about the conflicts that can create between different vehicles and about the ability to transfer skill sets amongst different types of structures before you venture full bore into those strategies.